for business people.
Decoded, digested and distilled. From the macros to the micros and everything in between. Good morning, you're watching BloombergQuint Live. I'm Menaka Doshi.
This is BloombergQuint Mornings. You're watching IndianOpen, and I'm Niraj Shah.
Good morning, I'm Ira Dugal. Let's get straight to the headlines. Asian markets move higher after US indices hit record highs. Data which showed that US manufacturing expanded at its fastest pace in 13 years boosts sentiment. September turning out to be a good month for the auto industry, with all vehicle manufacturers posting healthy monthly sales growth. SBI Life lifts on the exchanges today. Will it manage to buck the trend? A weak listing day performance for insurance firms. And 59 people are dead and more than 500 injured in Las Vegas after a gunman opens fire at a musical festival.
Yeah, it's been a wretched weekend if you look at all the news flow, which is, well, in a manner of speaking, terrible from a life's perspective. Las Vegas or the Mexico earthquake, or for that matter, the attack on the BSF camp. But
this morning, I know that was just the worst news to wake up to, in addition to everything else.
Yeah, so the news flow on that front hasn't been too positive. But if you look at what the markets are doing, guys, there's something to cheer. So here's the drill: S&P, Dow, Nasdaq, Cap 400, Russell 2000. All of them are at all-time highs. And while our markets kind of deviated a bit from this global correlation for the previous 3 days preceding the FNO expiry, I think we are back to basics, back to following the trend, and the trend is your friend, so please don't go around looking elsewhere. We'll start off on a good note. The SGX Nifty is indicating 9869. Keep in mind that we had a Monday holiday, so if you look at Friday's close to what the SGX Nifty is indicating, we'll have a start close to about 0.5% in the green, which is actually pretty good news for ourselves. So what should one watch out for this week or for the next few days perspective? One, the RBI monetary policy day after, very, very interesting. Tomorrow, very interesting. The cement dispatches are a key monitorable as well. Keep in mind the cement stocks have done really, really well. We haven't had the dispatch numbers come out as yet. Let's wait and watch. If the numbers are good, then the uptrend on cement stocks might well continue. We'll have a listing, a muted one at that, SBI Life, so watch out for that as well. The dealing rooms are suggesting that we'll have a flattish start. The premiums suggesting about a flattish start as well. May well list at a discount, so let's wait and watch. We'll get to know it at 10. But in terms of stocks to watch out for today, and there are a bunch of them, so just watch out for all of these. 4 or 5 key autos companies have come out with the numbers. I think the two that stood out, Bajaj Auto and Tata Motors, exceptionally strong numbers compared to what was anticipated. CV sales, by and large, have looked good for Eicher and Tata Motors. Maybe Ashok Leyland will do that. So watch out for the auto companies. Watch out for ONGC. There's the calculation suggests that the EPS may go up by nearly 5% as a result of this. It's a stock in a strong uptrend. We've seen a bunch of buying into ONGC. Let's wait and watch if that continues. In all probability, should continue. Dr. Reddy's has announced the generic version of Renvela in the US markets, and Goldman Sachs believes that this could add about 5% to the net income for Dr. Reddy's. So this is an interesting one. And I'm sure we'll talk in detail about RCom-Aircel merger called off. Maybe the PSU banks stay firmly in focus as a result of that as well. But the calculations, guys, suggest ONGC, Reddy's, auto companies, all of these.
Auto has been actually quite interesting because it speaks of both restocking and consumer demand, right? And I think that's been an interesting story to follow going into festival season. Gives you some hope that, things are maybe not as bleak as they look on the economic front. So.
Yeah, and for Bajaj Auto, even the exports have done well. Maybe.
Yeah, so very, very well. In fact, that company's made a strong comeback this month, and Tata Motors as well. So, yep. Lots of interesting stocks to look out for. Today on First Word, though, we're looking at 3 or 4 big stories. First up, possibly the first ever Ambani company insolvency. Now, you'd never think you'd hear that in India, but it's a big one. What does that mean for lenders is the more pertinent question, because it will be banks in focus considering the large amounts of debt. SEBI dials back its debt default disclosure requirement, and that's a step back for much-needed transparency. We also look at the possible up move for gas producers after the government hiked administered prices for the first time in 3 years. Those are the few stories that we're focusing on, and let's kick it off with the story that broke over the weekend, Sunday evening, as the Ambanis are wont to do. They love weekend news, and that's when the news came in that the merger was being called off, Ira.
Absolutely. The RCom-Airtel merger, I'm sure you've heard already, is off. The big question from here on is, well, what happens next? Not just for RCom, but for banks, this is extremely important. Remember that lenders had invoked strategic debt restructuring for the account back in June on the premise that the deals both with Aircel and with Brookfield for its tower assets will go through. One has fallen through, the other is yet to conclude. So lenders are left scratching their heads. Before we start discussing the implications of this, Vishwanath Nair is joining us. Vishwanath, we need to understand firstly why this is so important for banks, why they had invoked SDR on the premise that these deals are on the table, and where they are now.
You're right, Ira. So in June, when the bankers, the domestic lenders at least, got together and decided to invoke SDR in RCom, the condition was that you will complete these deals, the Aircel merger as well as the tower deal, as well as some of the other smaller deals that were in the pipeline. But Aircel was the big one, and since that is not happening, there are questions being raised about the whole SDR scheme. Now, under SDR, typically you get a period of 6 or 7 months before you have to convert debt to equity and control about 51% stake in the company. That seems to be the next logical step for the lenders. They did not want to do this. They wanted the bankers, the company, to complete these deals before December 2017 and avoid this whole process of conversion. But now they're being forced to do that. That is the next step. But what happens after that is an important question. Domestic lenders have about 18,000 odd crore worth of debt, with exposure to the account, and the total account is about 45,000 crore. So it means a lot to them if the deal doesn't go through and they're forced to convert. That's what's happening in this deal currently, Ira.
Vishnu, there are a couple of issues, right? They have a few options. One is that they cannot do the actual conversion and they can choose to invoke insolvency. Two, they can do the conversion and then sit on that equity all the way until December 18 in the hope that something will happen in that period.
That's right. So under SDR, as we all know, there's an 18-month period that they have to sell the stake that they've acquired to a buyer who they deem fit. But in the past, SDR hasn't worked really very successfully in multiple cases where where it has been invoked. The other point about insolvency, now I had a chat with a number of lenders and advisors who have been working on the RCom case, and they seem to suggest that insolvency is now going to be a last resort sort of situation, because the RBI requires banks to provide about 50% of the secured assets upfront. It can be spread over 3 quarters, but still it's upfront before the resolution even happens. So that is going to be a big pain. The state bank group banks have about 3,300 crore worth of exposure in this. So 50% of that is a huge number even for a State Bank of India. And multiple banks are involved in this case. So insolvency is most likely going to be a last resort, is what we understand from the bankers.
Yeah, so they're stuck between a rock and a hard place. Absolutely. Because you did the SDR only because you thought these deals were in the works. And therefore, you would not have to go through the process of actually finding buyers for these assets. Yeah. Because otherwise, what are you going to do with the equity? You're just stuck, right?
No, absolutely. And you invoked SDR because, I mean, this is when things come back to hit you in the face, right? I mean, the account, from everything we had heard from sources at that point, was on the verge of turning NPA. Banks took the easy way out, saying that we don't want a provision right now. Oh, these company guys are telling us that they have it all prepared. So, this is the easy option.
Let's hit the SDR button.
Yes, exactly.
I know.
And now it's come back and hit them in the face.
It's living in denial, because I'll tell you what, 100%. I think these deals, if I remember correctly, Vishwanath, and you might correct me, were both from last year. Brookfield, they kept saying it's closed, but it hasn't been consummated in any fashion, right?
The deal was supposed to...
it was contingent on the Aircel deal, wasn't it?
Yeah. So now that the Aircel tenancies aren't coming in, and we have Punit Garg, the executive director at RCom, giving interviews multiple across papers, where he's saying that the deal is being reworked, and now that Aircel is not part of the deal, the valuation will change, obviously. 11,000 crore was the valuation that they gave in December 2016 when the deal was originally announced. But clearly that valuation will change and probably much lower than what they're expected.
So the SDR is going to come and bite them back in the face.
100%.
And if they're saying that they don't want to go through the insolvency process because that requires for provisioning 50% up front, then what are they going to do? Pray that this business recovers in the front.
Which is
in the
not
face
going
of
to,
very
right?
serious. There's no this actually, Ira, it's not a laughing matter. In the face of really serious competitive
Absolutely.
pressures.
No,
right?
I'm not laughing at this issue. I'm laughing at the bank's ability to keep, putting their head in the sand. I mean, the ostrich phenomena within banks is just, it's become legendary now. But the other point also is that, we don't know that RCom is there in the second list of the RBI accounts or not. I have to admit that we don't know that for a fact. But at some point, the Reserve Bank of India can come
and
in
that
and
is
say
the
they've solved
opacity
guys.
this system is working with. The RBI won't put out lists and clarify who they've sent to insolvency or not. The lenders are living through the in denial mode or the ostrich head in the sand mode. You've got to look at what is the quantum we're looking at, right? We're looking at about 40,000 crores of debt
Total
on the
debt,
Reliance Communications side.
Yeah.
Assuming some of it gets reduced by whatever part of the Brookfield deal that does go through. Let's be optimistic on this. You're looking at another 18,000 crores of debt on the Aircel side. So my first question to you and everybody who watches the banking space is we're looking at about 50,000 crores and northward of debt now seriously going to have to be provided for in the next few quarters. That's if they finally bite the reality bit.
Yes, there will be increased provisions, but to be entirely fair, it's not that it would have not been provided for at all. I mean, there would be some provision, and they would, they would ramp it up. But yes, it would be a significant impact. There's no doubt about that.
And RCom has put through, I know, an asset sale plan over the weekend. But this, from what we understand, includes the Brookfield thing, which we don't know will go through in what form, includes selling real estate from across the country. We don't know what that value will be, includes spectrum, trading, as they pointed out, and optimization of spectrum was their terminology. But even there are question marks because some of that spectrum expires in 2021. Some new spectrum or some new rights come through in the Sistema deal. But nobody is really clear as to what amount. They put it at 19,000 crores.
That's the number they put in.
Yeah, they said the spectrum's valued at 19,000 crores. But, no one really knows what you're going to be able to realize out of that. So the asset sale plan has a big question mark on it right
100%.
now. And as Vishy pointed out, the banks seem unclear on what they're going to do to move ahead.
They are.
Yeah, let's put that question to Manish Ostwal. He's senior research analyst at Nirmal Bang Securities. Manish, how worried are you that banks are going to take a really big hit in the next few quarters, or do you think they're going to continue to live in denial?
No, it is not a case of denial. They have to make provision for the stress asset because ultimately the ability of the borrower is getting affected because of not having a deal. So whether RBI asks for or not, they have to provide as a prudent banker. If they are not providing, market will take it as a ad hoc provision for that.
Market will take an ad hoc provision if they don't provide it themselves, right?
Yeah.
So you're going to see it reflected in all the bank share prices over a period of time, correct?
Yes.
All right, Manish, thanks very much for that quick take. I can't believe they won't go through insolvency proceedings.
I think they should. I mean, I think, if you have to provision, there's just no way around it. So do it. I mean, these banks are going to take a hit. I would just, advise, not that anybody is asking or taking my advice, but I would just advise that there's no way out unless you have some visibility of a deal. Maybe we don't know. Maybe they do. If there is some visibility of a deal, sure, go through.
What deal?
I don't know.
I mean, where is the space for consolidation left in this industry?
So,
who would want the RCom assets? The only deal that seemed to make sense was with Aircel, if anything at all, unless Bharti or someone wants to pick and choose certain assets, right?
And I wonder, so I don't know, this is not clear to me, but can they do, some deleveraging at the group level, which would help the promoters pump in some money? There was a story over the weekend in the Economic Times that suggested that there is some interest, or there is interest in Reliance Infrastructure's Mumbai power assets. Now, I don't know if they're looking at deleveraging at a group level, which allows promoters to pump in more equity. I don't know.
Reliance Infrastructure's power. That's
That's
also a listed company,
yes,
right?
Yes. But I mean, the promoters can deleverage, right? And the promoters can put in equity.
Yeah, but if you sell assets in the listed company, which is Reliance Infrastructure, the money goes to the company.
Unless the promoters are...
How does the money go to the promoters? How are the promoters on their own going to make money through the sale of any asset which is owned by a listed company in the group and thereby then bring that money
they don't
in as
have
equity.
that option either.
So they have to sell personal assets. Now, what are those personal assets? Unless you're selling shareholding in any of these companies, like Reliance Capital. I mean, look, this is wild guessing here, so I won't go further. But that's the only way you can bring in further equity, right? Yeah. So, like we said at the beginning, it's RCom and all of its lenders, and Aircel as well, stuck between a rock and a hard place this morning. The other disappointing news that came in this weekend was, the news that came in from SEBI. Now, it's a breather for listed companies, but it's a step back for transparency because SEBI has deferred its order that required companies to inform exchanges the very next day if they defaulted on any loan payments, whether these are bond payments or these are bank loan payments. The market regulator has, over the weekend, put off the implementation of this directive, which was to kick in on the 1st of October, and it says that this directive has been put off until further notice. Don't nod your head like that.
No, I mean, so this ties in directly to RCom, right? I mean, cases like RCom are the reason this would have been so effective. That the minute stress starts to build up in a company, it gets communicated to investors, whether they're in their debt securities or in their equity securities. It also makes it tougher for banks to hide these bad loans, right? Because everybody knows that these guys are 10 days overdue, 20 days overdue, 60 days overdue. Now, I think the debate, we've all been having the same debate is, was one day too harsh? Could there have been a midway? And I think there could have been. And perhaps, I don't know if SEBI is rethinking this or not. If one day was technical, then you could have looked at a 15-day period, or you could have gone with the Reserve Bank of India's SMA, which is special mention account definition, which is that at 30 days, you go into SMA. I mean, so withdrawing it entirely sends a terrible message out there. A time when you're trying to
sends a message that you didn't think through this when you put it out in the first place.
100%.
I mean, did you not consult credit rating agencies, banks, companies before you put this out? Did you not realize that one day would be difficult to accomplish? Did you not anticipate that we'd be going through a tumultuous time in the economy with GST, etc.?
Yeah, and if you're just doing this, I mean, a regulator, you have to keep the best interests of financial stability in mind, not the market rally. And if this is being done because markets would have become too nervous or too volatile, I don't think that's the way to handle it.
Well,
but this has a window for coming back, right?
Well, they haven't said, right? They had a one-line release. So people are assuming, and there has been some reports that they would come out with a revised formula of doing this. But there was a one-line release saying that...
I think it speaks poorly of a regulator that didn't think through the directive in the first place. I mean, it does not earn SEBI any brownie points for having done this. If it did it in haste, then that's bad. If it's pulled it back under pressure, then that's worse. So I don't know how to find anything good in this, except to hope that it comes back in some revised format. And if it does, then we'll see,
Yeah, it's a bad signal. We thought transparency would be good, but now we're not sure we want transparency. So, let's pull this back.
Clearly, you have two unhappy people this morning in the studio, I think, right?
No, okay. It's, as I said, spate of bad news. But as I said, all bad news come with some share of good news as well. So while I've had a lot of bad news, there are some good news as well. Markets are doing well, and there are some good price-moving news on specific things that will keep the market participants excited, guys.
Okay, let's get on to it then.
Yeah, so the government, as I'm sure viewers know, revised the prices of natural gas for the first time in 3 years. Price at $2.89 per MMBTU is likely to give a boost to the gas business according to almost all brokerages. Somit is here with more details. Somit, good morning.
Good morning, Niraj. So the domestic natural gas prices have been revised for the second half of financial year 2018. Now the new prices have been hiked by 17% to $2.89 per million British thermal unit for the second half of financial year 2018. Now the government last raised gas prices in November 2014, and this is the first hike in the last 3 years. Now the last time they raised prices was when they introduced a new pricing formula, and since then, if you see, government has reduced the gas prices by more than half, making which turned the gas business of the ONGC loss making. Now this revision in gas prices in the second half of financial year 2018 would bring in some relief for the upstream major and could lift the gas business in the second half of financial year 2018. Now according to Jeffries, every $1 rise in gas price increases ONGC's EPS by 10 to 14%. Also post this 17% hike, Jeffries is expecting another 15% hike in gas prices in the next 12 months. Now for the first quarter, ONGC produced nearly 6 billion cubic meters of gas, and for financial year 2018, they are eyeing a production increase of 10% to 25.6 billion cubic meter.
So, Samit, I guess if I looked at a couple of notes, and I think all of them were saying that the hike in earnings for ONGC could be a tune of 5%. I think the ranges vary from 3 to 7 odd percent.
5 to 7%.
Right. What about the other players, Sumit?
Huh?
What about the other players?
Other players like there's Oil India, there's Reliance, but then their production of gas is very low. ONGC is the only one with the maximum gas production, and we'll see most of the impact coming in for ONGC compared to other players like HOEC, Oil India, and Reliance Industries for that matter.
Didn't we just read about Reliance buying back its own gas from the CBM fields?
Yeah, but then that's like they're paying their own company.
Yeah, well, because I think they got nobody else at the price they wanted. So.
Yeah. But the key thing
that's good. Reliance now has to pay more to Reliance.
Okay, that's an interesting thought.
There's too much Reliance this morning.
Yeah, there's too much Reliance this morning.
Well.
No, but just the thought, before this came about, or maybe in anticipation of this coming out, the entire street turned bullish on ONGC. After a really long time, we heard people on the street unanimously saying that if there is one upstream company they're okay buying, or maybe very keen to buy, that is ONGC, after getting decimated for the last 3 years.
Because of crude prices.
Yes. So can this kind of finally, from a trader's or an investor's perspective, revive that sentiment or extend the sentiment a bit? The stock has had a bit of a rally last week as well. Maybe this has the potential to give more legs to this rally.
Yeah, we've also got the HPCL merger to contend with in this process, isn't it?
Yeah, at fair market value, I presume is what they said, November to December, fair market value.
That is an art. Valuation is an art. I'm telling you, valuation is an art.
True.
Fair market value is also an art. But anyways, they can't get very far away from the listed price.
Yeah.
But then you never know. SpiceJet sold at $2, right? Isn't that what we reported?
$1, $2.
$2, yeah, $2 a share when it sold to Ajay Singh. So, yep. All right then.
All right, moving on to autos. So we've got some good numbers coming in from the car, two-wheeler and commercial vehicle makers. That's for the month of September. Does it portend a turnaround? Does it portend some sort of strength in the consumer space, which we were starting to question? Darshan Mehta is standing by with the numbers. Darshan.
Good morning, Ira. And the numbers at this point of time look pretty decent. There have been 4 major companies that have reported numbers. And it's not a disappointment from any of them. In fact, 2 of them did manage to surprise massively. Now, let's start with the biggest one, and that is Maruti. Maruti came out with numbers which were in line. So 1,63,000 units were sold in the month of September. This is the total number compared to our estimate of 1,62,000. Basically, exports were weak. They fell in close to 2%. The passenger car vehicle grew almost 11%, and the UV segment grew 8%. Majority of the units that were sold came in as far as the compact car is concerned, which grew almost 44%. But this comes on the back of issues as far as capacity constraints is concerned and on a high base. So, and that helped a lot of other companies like Hyundai and all to grow because there are capacity constraints at Maruti. Tata Motors, really surprising number, 57,852 units were sold compared to our estimate of 54,000 units. Apart from it, domestic commercial vehicle sales were up almost 29%. Their medium and heavy commercial vehicle sales did extremely well. Even on the passenger car vehicle, 18% growth was seen. What didn't work for Tata Motors was the export, which fell in almost 27%. JLR numbers are yet to be reported, and we'll tell them once they come out. Bajaj Auto was the biggest surprise. 4,28,752 units were sold. Our estimate was 3,92,000 units. Mainly the motorcycle sales were extremely strong, 11% growth that came in, and the commercial vehicle sales were good, almost 32% growth that came in. So Bajaj now has been the best performing two-wheeler. Hero and TVS have not come out, and Eicher came out with an inline set of numbers. Royal Enfield sales came in at 70,400 units compared to our estimate of 71,000. The growth basically came in from the 350cc unit to lower levels. That grew significantly. The units that had cc of more than 350, that actually saw a degrowth of almost 24%. The commercial vehicle arm of Enfield did extremely well. That's the of Eicher did extremely well. So that came in at sales of 6,000 units, 6,083 compared to our estimate of almost 5,000 units. So overall, till now, this is pre-festive sales. Diwali is not yet hit in, but the numbers, most of them have given a double-digit growth, and the analysts have actually given a thumbs up to the 4 numbers that have come out till now.
Hey, Darshan, any insights on how come both Tata Motors and Bajaj managed this fairly good recovery in their key segments?
See, so Tata Motors, basically what happened was the fact that their commercial vehicles did extremely well. And if you see what happened with us, so that's why the expectation for Ashok Leyland is also decent. The Navratri sales have been good. What has happened with Ashok Leyland was up 5% on anticipation of strong sales. Bajaj Auto, basically this time around, their commercial vehicle numbers have also been included this time. That wasn't there the case that time, so that has actually come in decent. But even their motorcycle sales has seen a double-digit growth. So overall numbers have been good for all of them. Maruti will obviously the capacity constraint is impacting Maruti. That is why they haven't been able to delivering, and that is why if you saw Hyundai saw a growth of 17% in the September, and that is coming at the cost of Maruti. So once Maruti gets its new plant ready and everything will roll out, that is time the Maruti will also start firing. But it's not a bad number from Maruti because their compact sale numbers, compact car sales have been really good this time.
Any word from dealers, etc., on the discounting this festival season, and whether that will, while sales are looking very good, did most manufacturers have to resort to deep discounting? I'm just curious because this Bajaj recovery in two-wheelers is interesting. So I'm just wondering whether any of it can be attributed to deep discounting.
I actually have no clue. I haven't spoken.
Okay, fair enough.
I'll try to find out and I'll get back.
Thank you so much for that. All right, so that's Darshan giving you the lowdown on auto sales numbers.
Just a couple of thoughts. So one, I think Bajaj revived quite a bit because of the export numbers as well, which were very, very good for Bajaj Auto. But two, I think the interesting thing that came out, and we'll get to know once Ashok Leyland numbers come out as well, but Gopal Mahadevan was fairly optimistic when he spoke to us on Friday. Tata Motors, Eicher, not Royal Enfield, sorry, they are unanimous, but Eicher Motors, Tata Motors, the CV numbers were very good. If Ashok Leyland does an encore, and if the commentary for the next 2 months is pretty good, think of the impact that some of the CV OEM suppliers will have as well, the likes of Jamna Auto and a few others, which are pure play CV suppliers in the auto ang space. They could have a fairly reasonable next 2 or 3 months as well. So this will not just reflect on the prices of the automakers, but the auto component suppliers will have a field day the next 2 or 3 months.
Any recovery in CVs, if Ira will bear me out on this, is very good news for the underlying economy as well.
It is. I was surprised to hear Ashok Leyland speaking about it, and I think he talked about tippers, etc., which is mining
construction
activity.
and mining, yeah.
So yeah, if that's a trend, then it
like
says
I said,
something.
right? I think we discussed this on Friday. The moment you start speaking of an economic slowdown, it comes back and hits you in the face.
I think we'll get some PMI numbers today, which will tell us what the overall manufacturing activity looked like as well. So let's see if there was a rebound in September. Yeah.
Fingers crossed.
Yeah.
We could do with some good news. All right, that's all we have for you on First Word this morning. But remember to stay tuned all through Indian Open. In just a bit, we'll also bring to you Markets and Macros with Saurabh Mukherjee of Ambit Capital. Make sure you tune into that. And the multi-trillion-dollar investment opportunity in Indian markets with Rhythm Desai of Morgan Stanley. Both those big conversations coming up in just a bit.
Well, full tilt towards the trading day today. Let's first take a look at the derivative space. Almost the start of the new series. Navneet Saluja is standing by with their setup. And Navneet, the first day of the new series, the October series, wasn't bad at all.
Not at all, Neeraj. Good morning to you. And in fact, we are eyeing for a gap up opening. That's what the SGX Nifty is suggesting. It was a long weekend, so let me just take you through a quick recap as to what happened on Friday. Well, the Nifty did touch the 9850 mark. It gyrated almost 80 points, but finally we closed off day's high. So Nifty futures, if you look at it, the open interest went up by almost 4%, still trading with a premium of almost 12 points. But remember that premium went down if you compare on day-to-day basis. In terms of Bank Nifty futures, we did see the open interest surging almost 6%. Bank Nifty too ended the day above the 24,000 mark, but still off day's high. But the good news was that the Nifty ended, even the Bank Nifty, above its 100-day moving average. In terms of the put-call ratio, we did see the Nifty PCR falling to levels of 1.19 and the Bank Nifty PCR well to levels of about 0.91. If you look at the Nifty PCR, there was more of call addition which was seen in Friday's trading session, and precisely that's the reason why the Nifty PCR fell. Let's just pull up the quickly the active strikes in Friday's session. 9900 call that added almost 9 lakh shares, and you had the other strike 9800 put that also added in that range of 8 lakh shares. If you look at the premium of both these strikes, it tells you the near-term range for the markets will be 9680 on the downside to almost 9970 on the upside. Well, how are the FIs positioning themselves for the October series? On Friday, they're still 56% net long on index futures. but there was more addition seen on the call side. Almost 13,000 contracts were added on the long side, whereas the short side also saw some sort of addition. In terms of options, well, they added more of puts on Friday, and in terms of writing too, more of writing was seen on the call side. So clearly, they've been hedging themselves on the option side. Lastly, quickly, which are the stock futures to keep an eye on? Indiabulls Real Estate has entered into the ban period. First day of the new series, the stock was up 6.5%. We did highlight for you on Friday that it could enter into the ban. And finally, do keep an eye on Escorts. Open interest was up 9%. The stock was also up nearly 3.5%. Some sort of long additions were seen there.
Okay, we'll watch out for all of these. Maybe ask Abhijit about some of these as well. Thanks a lot for that, Navneet. Abhijit Pathak, Director at Definet Solutions, joins us this morning, as usual, with his thoughts on the F&O space. Abhijit, good morning. It's turning out to be a good start to the new series. We'll have a gap up today as well. Keeping those levels in mind, what should an average trader do?
Yeah, actually that nervousness on Friday evening was just maybe because of the long weekend, and the short-term trend which was up has not been disturbed. But at the same time, Nifty most probably will gap up in the resistance band between 98.50 and 99.20. And it is safe to carry longs only on a close above 99.20. If anyone has that 10,000 call which was bought near 35.40, it should be booked near 55.60. If it crosses 60, then that means Nifty will cross the resistance also. Then Nifty can go even up to 10,000.
So what's the strategy that you're advising this morning on the index, Abhijit?
Yeah, hold the 10,000 call which was bought, and if it crosses 60, just trail it. That's all. I mean, it is difficult to go fresh long on such a gap up because the SGX Nifty suggests 9890, which is even above the high of Friday. So there'll be a lot of shorts which might be trapped, and there might be short covering. But at the same time, unless 99.20, 99.30 on the spot is crossed, it is a bit dangerous to go fresh long at these levels.
You have a short straddle strategy as well, Abhijit?
Yeah, short straddle, which was 9800 short straddle, which is if it is available near 235, 240. But problem is with this gap up, you can't say at what level it will be. But if it does not cross 270, it is a good to short this 9800 straddle, the call and the put both.
Okay, fair call. Abhijit, one quick question on the stock strategy for the day. I presume you are recommending traders to go out and initiate a long on Larsen.
Yeah, Larsen has taken support near 1100, 1120 for quite almost a couple of months now. So it is a good low risk long if it is available near 1120, 1140 in the futures. And it can go up to 1120 in the next few days if 1100 is not breached. That is the stop loss.
Fair call. Abhijit, thanks a lot for joining us and giving us that perspective. Now, we have a lot of viewers who are asking us specific questions on our social media pages. So Amit is asking about advice on ITC and SBI. I believe the responses on some of these would come in on the Ask BQ show at 12:30. Amit, so do tune in for that. Bhavesh Astik is asking about a call option on Just Dial. We'll talk about that on the show today, Bhavesh, so maybe you could stay tuned for that. And there is a question on Amara Raja batteries from RK Daharwal. He's bought in the stock, 70 shares at 730 for a short-term bounce, if I'm not wrong. I think we'll talk about these stocks, Amara Raja for sure, a bit later on in the show, Mr. Daharwal, so do stay tuned for that as well. But for now, let's get in Pradeep Pandya on the show as well with a quick check on what's happening in the commodity space as well. Pradeep, good morning.
Good morning, Niraj. Commodities are kind of cooling off. One of the factors driving this correction or long unwinding is the rising dollar on the back of rising US yields. And if you look at gold, which is impacted directly by this movement in forex market, it has closed at roughly 7 weeks low. If you look at other commodities, for example, crude, there is good news actually. It fell by $1 yesterday, although in Indian market we see crude products or gas prices moving up, but in fact crude is also cooling off now, and that is to an extent contributed by the the normalcy returning to US crude production. Rig counts are now going up. That's the good news. This has happened after several weeks now. If you look at other commodities, you'll have ice, sugar, which ended higher. You had rubber, which continues to fall, fell another 5% or so. And if we look at the Asian markets, steel and aluminium ended lower on Friday, while zinc and copper have kind of firmed up. So zinc and copper, that's this very small segment which is actually kind of gaining some strength, and maybe sugar, while most other commodities today are going to probably see a downtick in Indian markets if you go by what we have seen globally.
Yeah, it's a blue day today. Menaka, Ira in blue, I'm in blue, you are in blue. What's happening? It's Tuesday morning blues?
Yeah, or a long extended weekend.
Yeah, coming back from that extended weekend blues. Yeah, maybe so. Okay, let's take a look at what the global markets are suggesting though this morning. Remember, we spoke about it. It's a start that most of the Asian markets are predicting towards the start in the green. The SGX Nifty 2 indicating that we'll start off on a positive note. In fact, the gap between the SGX Nifty levels and the Nifty futures levels on Friday is a good 0.5%. So we'll have a good day under the sun. Let's wait and watch whether we extend the gains from those levels or no. A lot will depend on what ONGCs and the auto names do in the session today. Something that is not market moving or index moving, but could move the wallets of investors or could move the wallets of flyers are air ticket rates, which might just get a bit more expensive this festive season as ATF prices have been hiked for the third straight month. But hey, Sumit, that's not what we want to talk about, is it? We want to talk about what the impact of this ATF price hike could be on the margins or the financials of the three listed air companies.
Now, on an average, the aviation turbine fuel prices have been increased by 6% and has been effective from 1st October 2017. Now, this is the third consecutive monthly hike in aviation turbine fuel prices for the financial year 2018. The first two hikes were in August and September. Now, on an average, ATF prices have been hiked by 6%, which is the highest month-on-month hike since January 2017. Now, in January 2017, the ATF prices were hiked by 8%. This rise in ATF prices will impact the profitability of airline companies in the third quarter of financial year 2018. Now, on an average, fuel cost as a percentage of revenue eats up nearly 1/3 of an airline company's revenue. Now, fuel cost as a percentage of revenue for Indigo has been in the range of 30 to 37% for the last 5 quarters, depending on the average fuel price in that quarter. Now, for SpiceJet and Jet Airways, it has been in the range of 26 to 34% and 22 to 29% in the last 5 quarters, respectively. Now, with high concentration of fuel cost in the total cost, with the rise in this fuel prices, you can obviously see an impact on their margins, which could go further down.
Okay, and any back of the envelope calculations, Somit, as to what the exact impact could be, or is it difficult to say right now?
It is very difficult to say what will be the exact impact beyond the margins, but then you can expect a margin hit of around 1 to 2 percentage points.
Wow, that's quite a bit. Okay, thanks a lot for that, Somit. So that's putting all of the news flow into perspective this morning. Gas price hikes, auto sales, and of course, RCom-Aircel merger called off and the resultant impact on banks. Let's talk about all of that with Mayuresh Joshi. He's fund manager at Angel Broking, and we haven't even spoken about Dr. Reddy's until now. It's such a packed morning. We'll do that also in a bit. But Mayuresh, good morning. Thanks for joining in. I'm starting off with the biggest piece of news, and that's the gas price hike. You can even argue RCom and Aircel is that. But let's start off with the gas price hike and the resultant impact on ONGC and the likes. What would you be doing this morning? Because ONGC is not a stock that is lying at 150. It's had a bit of an uptick as well. People have bought into it, and it's a large name. What does one do now this morning?
Morning, Niraj. So yes, I think if you look at the 6-month gas pricing revision which started taking place over the last few quarters, it was expected that the gas price will go up because I think the basket of natural gas in this quarter gone by has obviously gone up. So to that extent, yes, I think a sentiment positive for upstream companies. But again, I think ONGC's long-standing demands have been around that $4 mark. So to that extent, I think it is still a little bit on the downside in terms of expectations from the management in terms of earnings from the gas-based business. But clearly, I think there is a sentimental leg down for a lot of companies, specifically which consume gas on the power side, a lot of fertilizer companies which are using gas as their input. So largely, again, I think a sentimental leg down probably for these stocks. But again, I think a large part of the element even for city gas distribution companies, because I think the companies which are using administered gas prices, the APM prices, again, I think you would probably need to pass this through to the end consumer. So what kind of impact it has on volumes should be seen. So a sentimental leg down probably for city gas distribution companies, gas power plants, and a few fertilizer companies which are probably using gas. ONGC might have a sentimental uptick, but a lot more needs to be done in terms of incrementally having gas EBIT margins and for cash flows improve drastically.
So what's your call? Any stock that you like in particular?
So out of the whole space, again, I think, Pradeep, a lot of stocks have moved up significantly. IGL was something that I did like. So I think any declines on this stock can still be taken as an accumulative opportunity. And within the fertilizer space, again, I think, as I said, one really needs to be selective within the space. So Coromandel International is still something that I will still fancy on declines to be accumulated by long-term investors.
Mayuresh, very quickly, auto names, and what did you make of the sales numbers? Anything that enthused you enough to maybe look at that stock or the company this morning?
So out of the numbers reported, I think Tata Motors reported a very strong set of numbers, Neeraj. Bajaj Auto surprisingly had a very good set of numbers, specifically from the export markets, where the pain specifically seems to probably subside, specifically in the Nigerian and the Sri Lankan markets. So a large element probably in terms of how the volume growth will pick up on the domestic side needs to be seen. But it was expected that restocking and the festivities will probably have a lot to do in terms of volume growth sustaining for these companies. So generally, yes, I think Tata Motors has surprised on the positive. So I think the accumulative rating on Tata Motors still continues from our side.
Okay, so auto numbers are of course the big story of the day, and we'll keep track of those. But also there are so many more news to really catch up after an extended weekend and an eventful long weekend, so to say. But to begin with, DRL.
See, Dr. Reddy's will be in focus. It's definitely good news that came out because the market was anticipating this. So finally, they've launched the generic version of Renvela in the US markets. Overall, the market size is close to $2 billion, but for the US markets, the net sale is $800 million according to the IMS data that is there. Basically, there is the innovator now. Aurobindo Pharma already had the approval and they had launched the drug. So Dr. Reddy's is the third company that will come out. So definitely there will be price erosion and market share gains that will come in for Dr. Reddy's. Couple of brokerages that have come out and giving their view. Morgan Stanley is extremely bullish. They are saying that this could add almost 70 to 80 million dollars on the company, assuming a 30% market share and a 50% price drop. These are all very high margin products, so they expect an 80% plus margin on this drug. Nomura also expects sales of almost $30 million for FY17 and $40 million for FY19. They're not as optimistic as Morgan Stanley. And Goldman says that Renvela can add around 5% to the net income over the next 12 months. So overall, coming at a time when there is price erosion, there is issues as far as pricing and no products in the US, this comes as a big positive for Dr. Reddy's. The stock should react in the positive today.
Well, a lot of positive news finally coming in, but there are more stocks, more news to catch up with actually.
Right. So to start off with, PNC Infratech has been declared the lowest bidder for the 6th laning of a national highway in Uttar Pradesh. Now this will be executed on a hybrid annuity mode for a project cost of 2160 crores. You also have Peninsula Land, which has entered into an agreement to sell its Pune property for as much as 226 crores. Jet Airways, we have some news flow there. I mean, apart from the fact that airline stocks will be in focus on the back of that ATF price hike, La Tribune, which is a French weekly, it has reported that Jet Airways is in talks with Air France KLM for a possible joint venture. So we do need to keep an eye out for that one. And amongst the bulk deals, of course, on Friday, we did have IAFCI sell their 24% stake in Tourism Finance Corp. The interesting bit is the names of the buyers, which is out now. Red Kite Capital, which is a Delhi-based venture capital firm, they bought 13.3% stake from IFCI. You had India Opportunities 3 fund, which bought 4%. Banker Sanjeev Thomas has bought 2.5%, and Central Capital bought yet another 2%. So that's the breakup of IFCI's 24% stake sale. And yet another bulk deal, Gulf Oil Corp, where the promoter group Hinduja Power bought 1.6% stake, whereas investor Dilip Kumar Laki sold about 0.9% stake. So interesting names there as well.
And Rakam, what have you spotted this morning?
Well, a bunch of big stocks when it comes to stocks and news. Starting off with TCS. Now, in the US, there is a technology company called Epic, which had filed a case against TCS for stealing trade secrets. This is, of course, an ongoing case, and the US District Court for now has halved the punitive damages to 420 million from 970 million. This, of course, while it may be a positive development, TCS is suggesting that they will, file an appeal against this as well. Moving on, we have also reloss of Reliance Infra, and according to reports, we understand that Greenco, has made a $2.1 billion bid for Reliance Infra's Mumbai power business. So, well, we could expect a little bit of a move there as well. Alok Industries. ECL Finance agrees to give Alok Industries 150 crores in interim finance. It's a very small amount for the kind of, debt that Alok Industries has, but it could matter to a certain extent. And HUL, of course, has, divested its entire stake in Kimberly-Clark. This is something that we knew. It was in the cards, and we had also spoken about in July, and that has come to be. Of course, when it comes to the joint venture, Kotex and Huggies are the two very, key brands for this JV. So we will possibly see a little bit of shuffle in these brands.
Well, thanks a lot, Agam, Shraddha and Darshan for all the details. Mayuresh, your call on Dr. Reddy's. Would you like to buy at this level?
Not really. Again, I think I'll probably wait for numbers to come through because a lot has been happening in terms of FIR, in terms of the reports raised by the FDA. And again, I think the EIRs that have probably come out, it still needs resolution, and remediation costs are still going to remain on the higher side. So I think slow approvals, high R&D expenses, pricing pressures generally will tend to overweigh probably the long-term prospects for the company, which look positive with the kind of A&A pipeline that they've got. So I'm being very, very selective within the pharma space. My own sense is that the next 2 to 3 quarters, the pain might still persist for all these factors across the pharma value chain. But largely, I think Aurobindo Pharma is something that I've continued to like, and it clearly remains one of my favorites within the pharma space. But one has to buy this in a staggered way on declines.
Okay, Mayuresh, stay on 8:45, that time of the show wherein we get you some technical recommendations as well. Hadrian Mendonca, Senior Technical Analyst at IIFL, joins in on the show, as does Mukesh Singh. Gentlemen, good morning. Thanks for joining in. Hadrian, anything on the index that you would be doing? We'll start off with a bit of a gap. Is it prudent to enter at those levels?
Yes, definitely. See, the gap up that will happen, may not be able to sustain in the initial stages. But if you see the overall 3-month trading range for the Nifty, it is that 500-point trading range. If you see from early August, and currently Nifty is trading at the lows of the entire range. So the risk reward seems to be pretty in favor of the bulls currently. And the way we have bounced in the past 2 days, that is Thursday and Friday. I think the momentum will, slowly and gradually start building up as the days go on during the week. So I think definitely, after a gap and after a little bit of consolidation, one can go long in Nifty and play for the higher end of the range on the Nifty.
Okay, Mukesh, one heavyweight that could really drive Nifty up this morning is ONGC. What's your view on that? And because if you look at commodities market, oil is kind of cooling off. So what do you think? Did traders already, put in their positions, and now there could be, there may not be enough follow-up buying, or you'll still go long? Mukesh, are you able to hear me?
Yeah, good morning. Was the question for me?
Yeah, it was on ONGC, Mukesh. If you think a lot of good news is already priced in, or is there an opportunity to go long?
Sir, if you remember, on Friday I had given a buy on ONGC based on the classical double bottom kind of scenario. And it seems that prices got a wind of this pending news flow coming in. And I think this particular move is expected to hit somewhere around 190, 195. So I think there is a steam left in this particular stock. And I will continue with that buy position which we had recommended to our clients. And I will hope to book some profits around 190, 195.
Okay, so let's talk about specific stocks then. Hadrian, your ideas for this morning. What are you recommending and why?
Yeah, I'd like to go long on BPCL, specifically because, we have seen a very, very strong sell-off in the stock in the past 4 weeks. And after such a long time of, downtrending, prices, Thursday and Friday saw a very good, reversal of prices on the daily charts. And if you see the long-legged doji pattern that we saw in the previous week is going to act as a very strong reversal kind of a pattern for BPCL. So definitely one can go long on BPCL, keep a strict stop loss of 465, and one can play for a target of close to 490 to 495.
Okay. And Mukesh, you like another commodity stock, that is Vedanta?
Yeah, Vedanta seems to be performing quite admirably in spite of the overall decline in the last week of August in the overall market. And this one particular stock shows a lot of impulsive characteristic even on intraday charts. I would be a buyer around 314. Stop loss should be placed below 307, and target on the upside is seen around 327.28 in the immediate term.
Okay, Mukesh, your other strategy for the morning is Divi's Lab.
Yeah, Divi's has been on a tear in last couple of weeks. For last 4-5 days, it has been cooling off, and in this corrective decline, the setups remain undisturbed. It seems that in spite of all the gloom and doom surrounding this particular sector, but this one seems to have registered a long-term low, and we can see a bit of a momentum push continuing in this stock. I'm expecting much higher target areas, but buy in this particular stock will be triggered if it moves above 873 in today's session. The stop should be placed below 850, 657 kind of, and I'm expecting a move towards 910, 915 in the immediate term.
Adrian, you like Ira Motors, and if you look at the news coming in, 70,000, more than 70,000 vehicles sold in a month. That's again a new milestone for the company. But what are your targets?
Yeah, the news seems to be being factored in advance. If you see the Friday's move, the move has actually taken Ira Motors to close above its 50-day moving average, which is a very positive sign. Secondly, Ira Motors, the selling seems to be a little bit overdone over here. If you even see, the Bollinger Band, the way they are behaving, it seems to be, the selling seems to be overdone on that part as well. So I think Ira Motors, you can go long and keep a target of 31,500 plus in the short term. Your stop losses has to be very strict at around 31,070 levels.
Okay. Thanks so much for those ideas, gentlemen. Let's move on to Bloomberg Edge. That time when the Bloomberg terminal throws up some interesting insights, and Jayesh Khilnani joins us to tell us what the terminal is talking about. Jayesh, I think there is some indication for Ashok Leyland.
Morning, Niraj. Yes, so as of Friday's close, the trender indicator, which is a proprietary Bloomberg indicator, has turned positive and given a buy signal on Ashok Leyland. Now let's have a look at how the trender actually works. So it actually uses average true range as one of the key inputs for calculation, and it helps you to generate a buy and a sell signal. Also helps you to manage the trailing stop loss. So how do you interpret the trender? Is very simple, just follow the color. When it turns from red to green, it indicates a buy signal, and the other way around, when it turns from green to red, it indicates a sell signal. Now going back to the chart of Ashok Leyland. Now remember, the stock has gained more than 7% last week, but the trender has turned positive as of Friday's close. So that's where the last candle or the last couple of candles took place, and it has closed above the red trender, which indicates that a buy signal has been generated. If you look at historically, last month, somewhere early August, a couple of months back, early in August, there was a buy signal generated, and that move resulted in a 10% upside. So you can see this August move that has resulted in a 10% upside. So indicating that there could be further gains from here on as well.
Okay. And what's the analyst coverage on Ashok Leyland as of now, Jayesh?
So Niraj, most of the analysts have turned bullish on Ashok Leyland. So if you look at the analysts which are tracked by Bloomberg, there are 60% of the analysts have a buy recommendation, while 20% have a hold recommendation, and only 14 to 15% analysts on the street have a sell recommendation on Ashok Leyland. So the entire market also seems to be liking what Ashok Leyland is doing.
Thanks, Jayesh, for all the details. Mayuresh, if you look at it, we are still waiting for the Ashok Leyland sales numbers, but Tata Motors numbers are out. What's your call on this commercial vehicle space in general and on Ashok Leyland in particular?
So a large element of it, Pradeep, had been that because of BS4, a lot of pre-buying had taken place a couple of quarters back. But again, I think if you look at incremental demand coming through, LCV, or the last mile connectivity as we call it, and where Ashok Leyland probably has a lot of platforms to come through. My own sense is that the volume growth can be quite humongous over the next 2 to 3 years. Even for Tata Motors, the MHCV part has held up pretty well. And even the PV part, surprisingly, with the kind of launches that it has done and the kind of response that it has got, seems to be on a good path. So Ashok Leyland's volume growth should be quite reasonable over the next few quarters. And with that respect, I think the kind of earnings trajectory that the company can report can be quite reasonable as well. So I think the hold rating continues for Ashok Leyland. And as I said earlier, I think on the sum of parts, Tata Motors, with improving domestic business and expectations of volume growth stabilizing on the JLR front, including its Chinese JV operations, I think the accumulate rating on Tata Motors continues.
Hey, that's interesting. You know, I was just talking to Menaka and Ira in the morning as well, Pradeep, that one, the impact that some of the CV players will probably enjoy. So Ashok Leyland, maybe Tamo, though Eicher Motors could be interesting. But to the suppliers to CV, the auto component companies which pure play CV suppliers, the likes of Jamna Auto and a couple of others, the brake companies, etc., could have a fairly interesting next couple of months if indeed the commentary from the CV makers is positive. Ashok Leyland spoke to us and was very optimistic. The numbers are there to see from Tata Motors and Eicher, and if Ashok Leyland delivers those numbers as well, which at least from the conversation it seemed like they will, it could be a very interesting next 2 or 3 months for these companies.
Yeah, and actually if Ashok Leyland also comes out with strong numbers and they sustain for a month or two, that would also mean that, you know, all the talks of slowdown and, you know, stimulus probably came at the bottom, like, you know, it happens in markets, that you talk about gloom when the downside is actually getting over.
It's a lead indicator of sorts. Yeah. So we did ask this to Gopal Mahadev, and he was hopeful that even for the economy, it would be a lead indicator. We don't know that as yet. But the stocks are certainly in a strong uptrend of yours. Maybe just a quick question to Hedrin. Ashok Leyland, Hedrin, individually, the Bloomberg terminal says that there's more upside to this one. Would you buy it this morning?
Yes, definitely Ashok Leyland should be one of the very big buys in I'm not talking about a trading perspective, but I'm talking about someone who is really wanting to invest, because if you see the larger time frame analysis, what we see is something very strong that has been happening on the charts. If you see the monthly charts, Ashok Leyland has broken out from a very large flag pattern on the monthly charts, and I'm talking about an analysis that drags past to the year 2012 2011. So the way the prices are moving in a higher bottom higher top cycle, the structure continues to be very strong. The trend that Ashok Leyland has caught on to, the momentum that it is building on, I am really expecting if the breakout, if it turns out to be the way it should, Ashok Leyland has to be could see a target of close to 190 plus to 200 plus. Definitely I am talking about holding periods of close to 9 to 12 months. Ashok Leyland is a pure buy at these levels as well.
Okay, so a buy call on Ashok Leyland with a slightly longer term perspective here. SBI Life Insurance Company is headed to Dalal Street today. It's only the second life insurance to get listed on the exchanges. Saloni Dhanuka is standing by with all that we need to know about this company and its valuation. Saloni, SBI Life IPO didn't see as many takers as some of the other recent public offers, so to say. But what are brokerages pricing in for the listing now?
SBI Life Insurance will be listing its 8,400 crore IPO today, making it the second life insurer to list on Indian exchanges. The issue price is set at 700 rupees at the upper band, and in terms of subscription, the IPO has been oversubscribed over 3.5 times, with QIB subscribing over 12.5 times. However, the HNI and retail portion was undersubscribed due to weak market conditions and higher valuations, according to a Macquarie report. Now, in terms of financials, in terms of valuations, if the stock lists exactly at the issue price of 700 rupees, it will demand a market capitalization of over 70,000 crore. However, if the stock lists at a discount of 675 rupees, it will command a valuation of over 67,500 crore. However, if the stock lists at a premium of 725 rupees, the market cap would be around 72,500 crore. Now, given the market cap scenario, the price to book will vary in the range of 12.1 to 13.1 times. Now, in terms of financials, it is the largest private sector life insurer in India based on new business premium earned, and it has witnessed a 35% compounded annual growth rate over the same during the past 3 years. However, the net profit and asset under management grew at 8% and 17% CAGR for the same period. Now, in terms, when compared to its listed peer, SBI Life has an embedded value of 16,538 crore, which is again 400 crore more than ICICI Prudential. And at the upper band of this price band of 700 rupees, the stock will trade at 4.2 times its embedded value as compared to 3.8 times for ICICI Prudential. And the company enjoys a market share of 20% based on new business premium among the private players. And finally, talking about few facts about the company, that it has the highest 37th and 61st month persistency ratio, while it has one of the highest solvency ratio and lowest operating expense ratio of 7% among the private players. And finally, it has the highest debt settlement ratio of 98% among the pure play private players.
Okay, Saloni, thanks for putting that into perspective. Mayuresh, a 20-second answer if you can. SBI Life, what would you advise people to do?
Again, as Saloni was mentioning, I think because of valuations, I think not much left on the table. But again, a genuine long-term investor, and if the company is able to deliver a 20 to 25% premium growth over the next few years, which I'm very confident that a lot of life insurance companies will, because of the sheer under-penetration, I think that longer period will probably have these longer-term averages settle down, and then I think the premium re-rating happening onto the stock. So probably from a listing gain, not too sure how much can probably come through from today's listing. But for a long-term investor which has a view of around 2 to 3 years, I think the value for these stocks still remain very, very robust. So I think the bullish view on the sector does continue.
Okay, the pre-open rates have come in and it's a good start. Naturally, so we'll see this. Now, the numbers may vary, but we'll have anywhere between 0.5% to 1% kind of a start for the Nifty and the Sensex as well. I'm guessing all the other key indices also will start off in the green. Let's bring up ONGC, let's bring up Dr. Reddy's. We can also bring up RCom. I'm sure that that stock, in all probability, could be reacting a bit to the merger being called off. Dr. Reddy's will have a start in the green. And mind you, a lot of people bullish on this one. Starting off okay, RCom, well, not surprised there. I don't know if people really, I think the point that we made out this morning about whether this is the first, or that this could be, it's a question that we're asking, whether this could be the first Ambani firm to head towards insolvency, may not be completely unwarranted. They have a lot of assets, but this is, if you look at the brokerage notes, being viewed as a big negative, the biggest that we've seen in recent times for RCom. And maybe some of the PSU banks, the large lenders, could also be under question. So watch out for these names as well. And then, of course, the aviation companies, the Interglobes and the Jet Airways and the Spice Jets could well have a tick in the red today. Let's see if those ticks last or no. It was anticipated, but 5.8 is interesting. Will hit the margins as well. So those are a few stocks to watch out for, Pradeep.
Yeah, and let's also look at what's happening to Tata Motors and Tata Motors DVR after the sales numbers, and also the electric vehicle order that they have received. We should also have an eye on Jet Airways other than Spice Jet. Well, Tata Motors is up 7%, 8%. That's shocking.
When was the last time you saw that?
Yeah, let's hope it sustains. PNC Infratech is another mid-cap we should keep an eye on. 2,000 crore is a large order for a firm that has roughly 5,000 crore order backlog. But one should keep in mind it's a 15-year order though. And let's have a look at rupee. Dollar has strengthened quite a bit. So how has the Indian currency reacted? 65.63 versus 65.28.
Wow, what's happening there?
So that is actually the dollar moving up more than rupee falling on its own. But yeah, we are again probably all set to kind of move towards 66, and that would be interesting because we received quite a bit of support at that level, and even RBI may not like rupee to kind of breach this mark. But what's interesting, tomorrow is the RBI policy, and before that, rupee kind of weakening will shift the focus entirely on the when the RBI committee actually meets, the focus will be on foreign currency, and that would make them a little hawkish. So not so good for markets actually, because a lot of flows are actually coming in through debt market, not so much in equity. So if you cut rates, equities benefit, but debt may react negatively, and you may like to keep some of those flows.
Yeah, but even that, the RBI has turned off the tap, right, in the recent past, and therefore those flows too, by virtue of action that we wanted, has come off from what it used to be in the first 6 or 7 odd months. But maybe the silver lining, just before we get to Nikki, maybe the silver lining out here, Pradeep, is that if the rupee would have been stronger, some quarters of the market, whatever small quarter that the market that would in, would have thought that, hey, maybe there would be a rate cut. Now that that is not the case, at least the markets will head into the policy believing that it's status quo.
Yeah, maybe a commentary that will tell you that, okay, in case there is a slowdown like we fear, we are standing by, we are ready to take whatever action needed, something of that sort. That's the best you can expect, actually. Well, let's look at some more stocks. SH Kelkar and Jagran Prakashan, if you could look at. These are 2 more stocks to watch out for, and also Phoenix Mills that completed an acquisition. Jagran is up 5.5% on the news that HDFC Mutual Fund has increased stake. Phoenix hasn't traded yet, looks like. SH Kelkar maybe, if we had a look at it. And moving on, IDFC initiates coverage on Coal India with outperform rating. Nikki Mirchandani standing by, joins us with more on the brokerage report and rationale behind this move. Nikki.
So IDFC has initiated an outperform rating on the stock with a potential upside of nearly 15% with a target price of around 310. It says that the company is back on growth path after a subdued FY17. It says that issues like grey slippage, volume offtake and pricing pressure seems to be already factored in, and it does see a sales volume improvement in FY18 onwards due to improved demand from the power sector. It expects dividend per share of nearly rupees 19 and 23 for FY18 and 19, and expects the return of equity to double to 82% in FY20. It feels that the stock is currently undervalued at 5.8 times its FY20 EV to EBITDA.
Okay, thanks a lot for that, Nikki. So that's the IDFC view on Coal India, but that's clearly not center stage. What is center stage is the auto names. Mayuresh, I know we discussed auto just a while back, but Tata Motors individually, from the looks of it, will start off with a big bang. What would you advise people to do? For the longest time, maybe along with ONGC, Tata Motors has remained the cheapest index stock. Can people see some further buying into Tata Motors because of this change in numbers that we're seeing, not just this month? I think the last month wasn't too bad either.
Well, yes, Neeraj, and again, I think that consistency factor is something that the markets are looking forward for. So as I said, I think if they're able to maintain the consistency, which we feel they should, because on the domestic market, the kind of platforms that they have introduced, specifically on the PV side of the business, and the kind of response that they have received seems to be very, very encouraging for the domestic volume growth to sustain and pick up. And even on the JLR operations, which contributes to a large part to their EBIT on a consolidated basis, there the numbers should stabilize as well. Yes, I think you've got the currency impact in terms of what kind of forex hits and hedges the company takes, and it acts probably as a headwind. But a large element is that the valuations look very, very attractive even at the current juncture. So as I mentioned, I think if you are a long-term investor, the valuations are mouth-watering even at the current level. B, I think the sustenance in terms of volumes stabilizing both for the domestic and the JLR operations seems to be on the card. And with that, I think the EBITDA margins should also sustain both for the domestic and the international operations. So yes, as I said, I think we remain positive on the stock and the accumulator rating continues.
Okay, thanks Mayuresh for joining us this morning. And Hedren, if you look at Tata Motors and also Tata Motors DVR, what would be your targets next here on?
Yeah, Tata Motors, if you see, is doing something very interesting here. In fact, we are, kind of anticipating in advance here. But as I see how prices are behaving, we are, all set to see an inverted head and shoulder pattern, in the process. The neckline and the breakout zone is coming close to the 420 zone for Tata Motors. And once we see prices, sustaining above the same, above the 420 neckline zone, I think the breakout, will be confirmed. And from there on, the projected target for Tata Motors with a month or two perspective is coming, for close to 460 to 470 plus levels. So Tata Motors, yes, definitely currently, is a very good buy from here on, and a breakout would, further add to the ongoing momentum.
Okay. Mukesh, before we thank you, if you had to bet on one stock for this morning, which one would that be?
I think I will go with the DVs. Once it starts trading above 873, I think one can get surprised with the kind of impulsive behavior it can show towards 915, 920.
Okay, Divi's from Mukesh Singh's end as well. Adrian, Mukesh, thank you so much, gentlemen, for joining in today and giving us those perspectives. Watch out for some of those calls as well. 908, the pre-open rates have settled. Just very quickly show you what the indices are doing before we tell you all that you need to know, and then get in our big guest for the morning. But here's what the indices are doing. At the end of 8 minutes, we have about 1% of an uptick on the Nifty and the Sensex. I would reckon that the mid caps and the small caps too would show that market breadth that we saw in Friday's session as well. So we'll have a good start to the markets by and large. So here's letting you know all that you need to know this morning. Strong start for Motown. Strong sales numbers from Tata Motors and Bajaj Auto individually for September. Maruti and Eicher Motors meet the BloombergQuint estimates.
Dr. Reddy's announces the launch of Renvela generics in the US market. Analysts see launch as a big boost for the company.
RCom says merger with Aircel lapsed by mutual consent. The company says it has outlined other alternatives to reduce 25,000 crores of debt. The stock starting off on a poor note.
And gas prices revised to $2.89 per MMBTU for second half of the year, while aviation turbine fuel price hiked on an average by 6% for the month of October.
Jet Airways will be in focus as French weekly La Tribune reports that the Indian carrier is in talks with Air France for a possible joint venture.
New listing on Dalal Street SBI Life Insurance list today with the issue price of 700 rupees per share.
It's a big news heavy day. We haven't even spoken about some of the bulk deals as yet, but all of that and more in a bit. For now, let's get in our big market voice for this morning. Saurabh Mukherjee needs no introduction, Chief Executive Officer at Ambit Capital. During our launch week, Saurabh, it's a special moment to have you. Thank you so much for joining in.
Congratulations.
Yep, thank you so much for that, Saurabh. Is the market likely to rejoice what is seeming like some green shoots of the economy, or you wouldn't read into these few astray numbers like the CV sales and other indicators as that possible green shoot?
I think the auto sales numbers have been reasonably healthy for a while now. I think a good couple of years. Car sales have been particularly healthy. Good to see motorcycle sales being in reasonably good shape. I think CV sales pickup is a positive portent. The challenge is the welter of negative data just keeps getting bigger by the passing month. So around 8-9 months ago, we were one of the few circumspect voices about the Indian economy. And I think I dare say that our circumspection, our concerns about the economy are increasingly consensus concerns. And to that extent, I think the stock market is sort of beginning to incorporate, beginning to bake in our concerns about the state of the economy, the state of the banking system, and more generally the corporate confidence context, which I think is fairly feeble in India today.
Yeah, so you have outlined these concerns for a while, as you rightly said. Where do we turn around the corner? Your Sensex target is 29,000, which is not too much of a downside. So will the market cap to GDP stay at the levels that it is, or do you believe that GDP growth slowdown could lead the markets to overshoot what you believe is a prudent Sensex target?
I think the overshooting, whether it's in foreign exchange markets or equity markets, seems to be a sort of a factor of life. And I don't think it's that much point in my speculating whether it'll go to 27 or 26 on the Sensex. I think if you ask, I think the more meaningful question that you've raised is how do we turn things around in India? I think the answers keep going back to the banking system. We have to find a way to repair the broken banking system. You cannot expect to build an economy, an underdeveloped economy like ours, $1,600 per capita income. We can't expect to build an economy like ours with a banking system where credit growth crawls along at 2, 3, 4% year after year. At the moment, the bond market is doing a good job of funding our car sales and our washing machine sales and our home loans. But the bond market is not meant to be the frontline funder of the economy. Last 12 months, the bond markets lent way more money than the banks have. So I think repairing the banking system would be a central issue. The other element which we are hoping to see is the GST teething issues gradually calm down over the next couple of quarters. I think for small businesses especially, The teething problems, the working capital challenges around GST are fairly meaningful. But I think, to be fair to the government and to small businesses, that's a function of time. I think there's IT systems issues, there's tax rule issues. Those, I think, get settled down over 2 quarters. If we can fix the banking system, and if the GST issues settle down sooner rather than later, by the end of this year, we might well be turning around a bearish call on the economy.
Talking about fixing the banking system, today has not been a great piece of news, right? RCom and the fact that SEBI transparency is also, there is a bit of a backstep, Pradeep.
Yeah, definitely. So what's your call on banking sector really? Because this, in spite of all these concerns, people have been finding several stories to bank on. What are you really doing?
Yeah, I suppose I think that the corporate life in India dictates that you find silver linings in the darkest of clouds. I think the banking system credit quality issues will worsen in the Q2 results. I don't have that much doubt that the NPA numbers, not just the large corporate NPA issues, which I think we're very familiar with, but I think small and mid corporates now, I think the NPA challenges are mounting there. The PSU banks have been on the firing line. I think the PSU banks will continue to get battered on credit quality again in small and mid corporate. The interesting question is, what about the private sector banks, the NBFCs and the HFCs? We saw in 1Q housing finance companies' credit quality deteriorate quite meaningfully. I reckon that the deterioration in credit quality in the housing finance companies continues. I don't think truck finance is in the greatest of shape. The data that we're getting on truckers is volumes, truck freight rates suggest truck finance will continue to weaken. Barring car finance, which I think is one big bright spot in India, thank God for that. Barring car finance, I think we've got credit quality challenges elsewhere.
Okay, so just hold on to that thought. We have 30 seconds or 20 seconds to market open. And let's focus on the wall and try and tell you what the start of the market is likely to be like. We'll have a start in the green for sure, so make no mistake about that. The question is whether we can extend those gains or no. 16 seconds to market open. In fact, 12 seconds to market open. And keep in mind, auto sales would be the focus. We will also have Dr. Reddy's and a couple of other stocks be in focus as well. RCom will start off on a negative note. So those are the 2 or 3 key monitorables. But here are the first rates. The Nifty starting off about 1% higher, 100 points for the index, close to 9,900. The Sensex about 300 points as well, so triple century there as well. And the Bank Nifty, or the Nifty Bank, call it whatever, is about 0.25% or 0.75% in the green. So that's actually pretty good news for the start perspective. The mid cap and the small cap indices about 1% higher, so the market bet could be positive. A lot of green on the Nifty heat map, I'm sure of it. Maybe a few stocks in the red. Yep, just 3 stocks in the red. That tells you the story today. We have a big bang start, and autos are leading the way. To an extent, Dr. Reddy's is leading the way. Not too much of an ONGC out there in the top gainers list, lying about 1.5% higher. So not too much, but it's autos that seems to be leading the way in the session today, and not surprised there at all. Let's bring up some individual names and try and talk about those. So exports has improved for Bajaj Auto. I could well say Tata Motors is the big mover, but let's start off with Bajaj Auto. Exports have improved there, and that's led to that stock moving up higher. And remember, this is a stock that's actually had a good uptrend the last few sessions, and it's doing rather well too. Tata Motors 5.5% higher. I don't remember the last time in the last 2 or 3 months or 4 months or maybe longer, but I've seen Tata Motors react with so much gusto. So 5.5% higher for this one. Good CV volumes there. Good CV volumes for Eicher as well, so interesting there. Gas price hike benefits. I think brokerages by and large have said that the improvement to the EPS could be to the tune of 5% odd, about 1% higher for ONGC. It's already baked in some gains in the last week. Keep that in mind. Dr. Reddy's and the new launch, 2.5% higher. Well, we've seen 2 or 3 brokerage notes give target price higher by almost 30 odd percent. Today's session about 2% higher. One piece of bad news for companies, but they're not reacting too badly. ATF prices hiked 5.8%. I think Somit was saying that the margin impact could be about 1.5%. No, not a bad reaction. So maybe the market mood taking all of these stocks to marginally higher in trade. Pradeep, what else?
Let's look at Bharat Forge and Ramakrishna Forging. First of all, as we actually thought that, after auto sales numbers, we'll also see a lot of action at these counters. We'll have more auto ancillary companies coming up on our screen as, the trade picks up. But let's look at PNC Infratech. The stock is up 10.5% now. on the back of that huge order they have received, 2,200 crores or so. But there are other infra stocks also in focus today. JP Associates has moved up by roughly 5% or so. You have several other construction and infra stocks like GMR and GVK doing quite well this morning. At least they've had a good start of the day. GVK Power is in fact up by 4.5%. Among others, you have Bombay Dyeing, and then you have metal stocks like Nalco, there is Moil. So these are some of the commodity stocks that have been doing well in trade early in the morning today. Among metal, you also have Jindal Stainless that has opened strong, and well, infra, you have J Kumar Infra as well, and among NBFCs, I see JM Financials that is up by around 2.5%. So overall, these are some of the sectors driving the market.
Well, so since NBFCs it is, which is moving up, and we'll talk about some of the individual movers as well in a bit, but sort of was speaking about car finance and NBFC, sort of you want to finish that point because that pocket hitherto has shown good growth, and the market is duly rewarded.
Absolutely.
Is there a change around the corner or no, not quite?
I think Q2 will still be healthy. I think numbers on NBFCs will be healthy even in the quarter that we're going to see. Car finance, NBFCs especially. I'm not so sure about CV finance. I think truck finance, there are some issues which are cropping up around both utilization of trucks and freight rates. But both the volume data on cars, as we can see from the auto companies, and the credit quality numbers, I think will be spanking there. The challenge, I think, is on the non-retail side. It's on the commercial side. Commercial is around 60% of loans outstanding in our country. And I think uniformly now, large, mid and SME credit quality is under pressure quarter after quarter. And I think that's going to worry any well-wisher of the Indian economy.
Okay, so what are the other leading indicators that you are tracking or you are picking up? Do you really think that there is probably a need for further stimulus both from RBI and the government?
I think in terms of leading indicators, what's very easy to do, I think, and everybody can access the data. You can see the credit rating agencies' daily rating actions, and I think there's very little doubt that in the last 3 months, the rating actions have decidedly become less favorable. Suspended ratings, downgrades are increasingly growing, which is one of the reasons I suspect why the SEBI circular, which was supposed to go live today, got shelved at the last possible moment. Vis-a-vis stimulus, I'm not sure where the money comes from, because as we saw in the 1Q GDP data, government spending had grown at a frenetic rate, 25-30% growth in government spending. And as we are hearing, by end of August, the government has eaten through 96% of the fiscal deficit. So unless the exchequer is willing to settle for a much bigger budget deficit, difficult to see where the money for the stimulus comes from.
Do you think they'll do that?
My reckoning is, I think if they're going to pull a rabbit out of the hat, it'll have to be on the disinvestment front. They might decide to disinvest something which we're not expecting them to disinvest, and that could give them some extra fiscal firepower. But if they're going to do that, they're going to do that quickly before the window of opportunity shuts on them. Without doing something which is non-linear, which is out of the box, such as a big disinvestment, difficult to see where we get the fiscal firepower to resurrect the economy's fortunes this year.
Okay, let's talk about some of the things that have happened today or over the weekend. One is, I know we spoke about autos, the gas price hike, sort of, and the revision thereof, and that leading to some upsurge in select upstream companies. And we were just discussing in the morning that it's probably meaningful for one ONGC, not so much for some of the others, even for Reliance for that matter. What happens to this upstream space? It's been underperforming for a while, save for Reliance.
I think that the tragedy for us is we quite liked the OMCs. We thought that India was on its way to deregulating the OMC space, and the OMCs had done ever so well. But obviously, as the gas prices, the global Brent price go up, even if the government allows the OMCs to pass on the Brent hike, which I'm pretty sure they will, from a refining margins perspective, there is pressure clearly building up on the OMCs. So it's a little sad, but hey, commodity prices are meant to fluctuate. The bigger issue, I think, is for the fisc, because I think off the top of my head, I think the budget bakes in something around Brent at around 60. And if global crude prices now go significantly north of 60, then I think we've got a fiscal challenge. Remember, there's excise baked into the price.
Yes.
So either the government passes on the Brent hike onto the public, or they take a hit to their excise revenues, which in the current fiscal construct appears a little difficult to do. So if the government protects its excise revenues and passes on the entire crude hike to the public, then that'll be laudable at one level. It'll be great to see an Indian government saying, yes, global crude prices are rising, but hey, it's deregulated fuel environment, I'm going to pass it on to you. So I think this is going to be one tricky call over the next couple of weeks for the powers that be in Delhi. Do I take a hit on excise, or do I pass on the entire hike in crude prices onto the public?
There's no question of, and I think the oil minister has ruled it out as well, there's no question of the government trying to regulate oil prices after 2.5, 3 years of going down the path of telling the world amply that, hey, we are deregulating this. So no interference with the OMCs, right?
That's what we are hoping for. That's what we are hoping for. But as I said, it'll be very interesting to see what happens here. The excise revenues, I think, are my big concern. I think the fisc is in tight position, as is evident from the budget deficit data, and I doubt the government will sacrifice its revenues. Therefore, I think we should all brace for significantly higher pump prices of petrol and diesel.
So what happens to interest rate? What do you expect RBI will do tomorrow and in the coming meetings?
Clearly, given the state of the economy, at least one rate cut is warranted over the next 3 to 4 months. Whether it comes tomorrow or not, I don't know. I simply don't know what will happen tomorrow. But at least 25 bips, perhaps even 50 bips is warranted over the next 3 to 4 months, given the state of the economy. Whether it will be tomorrow or not, I don't know.
Is this a change in stance, or I mean, have you?
So we were saying 25 bips further cut this year, but I think given how weak the economic climate is, we've increased the 25 bips to 25 to 50 this fiscal, because I think the economy is far weaker. Or rather, put it like this, the economy has weakened far more sharply in the last 3 months than we thought would happen. For example, the tax collection data for August is stunningly weak. The direct tax collection data, both income tax and corporate tax, you're down month on month, July versus August. You're down year on year, August this year versus August last year. So there is clearly pronounced economic weakness, which I'm sure the RBI will be cognizant of. And therefore, our sense is, rather than 25 bips of cuts this year, you're looking at more like 25 to 50. Whether it happens tomorrow, I'm not so sure. If I was the RBI, I would hold the firepower back, because my reckoning is the fisc will get tighter and tighter. Government spending growth will get weaker and weaker as we grow into the second half of the year. And therefore, I as the RBI would rather hold the firepower back rather than blow it out early. But I think the economic weakness point, I don't think there can be any two cases about it. The economy clearly is softened quite quickly in the last 6 months.
So will they be constrained by what's happening to rupee, and how does this weaker rupee really impact the markets, the earnings overall?
I doubt it. I think there's case to believe that the rupee was too strong at 64 odd. The rupee was too strong, so there's good reasons for believing that not too many people in India will be unhappy with the rupee with a 66 handle on it. I doubt the rupee will be the paramount concern of the central bank at this stage. I think they'll be far more worried about that if we cut prematurely, will we stoke inflation? That's a delicate judgment call. Given that monsoons haven't been great, the kharif crop has been a little below expectation. I think they'll be worried about will we stoke inflation if we cut prematurely, and that's why maybe they hold off for another month or so before cutting. But very difficult to see how we go through the next 3-4 months without at least one cut, perhaps two.
Okay. One final question from my end. In the 10 interesting things that you read in the note that you put out, the first one that you've spoken about is how entrepreneurs or investors who author or write things should beware of the impact that it could have, anecdotal evidence. Saurabh Mukherjee has written a book as well.
Yeah, so thankfully the book wasn't on me. When I read the book, it was about the legendary hedge fund manager's book, Ray Dalio's book. And I think the point we were making, and it's a Financial Times article, the point we were making is that when you start writing about yourself, you clearly believe what you have to say about yourself is very important. And he was suggesting that the FT point of view, that's the height of hubris. I think we've seen a few examples of that in our country, highly successful CEOs writing about themselves. Thankfully, that's far more common in the States than it is in India as yet.
Yeah, that's interesting.
So one last question, since your fiscal target is 29,000, and that is more or less, not significant downside, but kind of conservative at this point. So do you foresee a meaningful correction here on because of earnings slowdown or what happens globally?
I think if we don't see meaningful remedial action on the banking system over the next 2-3 months, I think there's every reason to worry about not just our fiscal target, not just our Sensex target, but generally about the stock market. You cannot run an economy this size with credit growth the way it has been for the last couple of years and with the banking system as moribund. I think we desperately hope that in the next 2 to 3 months we see significant, meaningful remedial action about the banking system's challenges. What the government could do without imperiling the fisc further is open this up to foreign and domestic institutional investors. As we know, DIIs have plenty of money. They'll only be too happy to recapitalize the top public sector banks, and that will get us, I think, back on the path towards having a solid, robust, strong economy.
So banks are a no-no?
I would say, I think that at the moment...
Even private sector, consumer facing?
Yeah, so I think barring 1 or 2 private sector banks for the last 7 or 8 months, we've told investors be wary of financials. On NBFCs, HFCs, we believe some of the valuations are out of this world. It's just surreal valuations given the underlying economic challenges. On the private sector banks, a couple of them we see some value. But overall, I think the banking system is a quite frightening area at this juncture. When you have SEBI putting off what sounds like a fairly straightforward directive, such as the one that was about to go effective today, when you have something like that getting postponed, you do have to worry about what the state of the financial system is.
Well, the markets have cooled off as well, but take a moment, Saurabh, to thank you for joining us today.
And congratulations again.
Thank you so much. Much appreciate you taking the time out. The markets have cooled off a bit from the highs of the day, so about 1%. In fact, the banks are the ones which are actually probably dragging the markets lower from where they were, because the Nifty Bank is almost ready to break into the red. So banking is where the pressure points seemingly lie. What we'll do is take a break, but lot of interesting chat. Rhythm Desai of Morgan Stanley joins us to talk about his report and the multi-trillion-dollar opportunity in Indian markets over the course of the next 10 years. That's coming up post this break. Stay tuned.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Decoded, digested, and distilled. From the macros to the micros and everything in between.
the Sensex, which is currently around 32,000, could rise to 100,000. Importantly, a large part of this return could be front-ended, i.e. we could register these returns as markets normally do in a non-linear fashion in just the coming 5 years. Our projections put India's market capitalization at over 6 trillion in 2027. That makes India one of the top 5 markets in the world, probably the best returning market, like it has been in the last 20 years. Our forecasts indicate that India could become a $6 trillion economy by 2027. What is significant about this is that India's per capita income will rise from its current level of 1,700 to 4,100, which means that India becomes a high middle income group country. This has big implications on India's consumption basket. We see India's consumer sector rise from its current market value of 500 billion to about 2 trillion in the next 10 years. It means that the consumer sector could become almost 1/3 of India's aggregate market cap by 2027. India's digital leap is going to change the way credit is farmed out in this country. Currently, credit is asset-backed. It will move to cash flow based. And this means that several constituents in this country which were outside the formal banking sector will enter the formal banking sector. Micro and small enterprises, for example, could see high teen growth rate in loans.
Well, that's Morgan Stanley's Rhythm Desai. I'm tempted to say reporting for BloombergQuint, but he's not. He's reporting on this fairly ambitious report that the Morgan Stanley team put together. It's called India's Digital Leap, the multi-trillion-dollar opportunity. And in this, you'll find some audacious expectations of the Indian economy. A $6 trillion economy and 130,000 on the Sensex. That's the 10-year call by Morgan Stanley. And it's running on 2 wheels, as Rhythm just explained, JAM and GST. We have the man himself here in studio with us this morning on BloombergQuint to talk us through what he's smoking.
Certainly not dope, man.
Well, I didn't suggest that, but I do really want to know, in this day and age, when it's so tough to make any kind of near or medium-term call, did you guys find the stomach to make a 10-year call predicated on all kinds of things, and then put in a long set of risks which ranged from geopolitics to elections in India to any change in privacy laws in India and across the world? So what prompted this?
It's easier to make 10-year calls.
Then 10-month calls, is it?
Then tomorrow's call,
Then
right?
tomorrow's
Because
call.
you'll test me out very, very quickly. Remember Nostradamus?
We'll remember you 10 years from now, 2027, right?
Yeah,
Hopefully
I know.
we'll all be around this table.
But you know, you start off by saying audacious. They're not audacious, actually. These are pretty...
So I'm hoping you'll explain to us why.
Yeah, they're I wouldn't say they're audacious forecasts, because if you look at 6 trillion, we're already at $2.2 trillion, heading for 2.4 trillion. So 6 trillion pegs us at about 11% nominal growth. That's actually less than what we've delivered in the last 15, 20 years. So it's not audacious. Yes, of course, growth has to slow down now because our base is high.
Effect, yeah.
You know, you look at the Sensex, of course, you quote the number 130, but that's actually the bull case. The base case is 100,000. That's the tripling of the Sensex in 10 years. That puts us at about 11% CAGR.
Which is
the
not so
20-year CAGR is 17%. I'm actually calling for a substantial slowdown in returns. Again, fairly consistent with our inflation and macro conditions. And also, you know, none of these returns should be seen without the context of the world. The world is also coming out of a very high return period. The last 30 years have been very good for equities. The next 30 may not be because the world is aging. So India's returns will also reflect that type of slowdown in global equity returns. So yeah, I mean, they look audacious because, you know, they're these big headline numbers, but the underlying logic is actually not that out of line with some rational expectations.
Okay, fair enough. One is the things that struck me the most, and it seems to be the central pillar of your report, Rhythm, a report that you and several members of your team have worked on together. And that has to do with, you've done the combination of GST and JAM. And essentially what this means is more granular data on who's buying what in this economy, who's spending where in this economy, who's paying how much tax. And effectively what that boils down to is simply a bigger lending economy, right? Because banks and lenders have better data, consumers have the ability to borrow more with a growing economy, as you pointed out. All of this having a multiplier effect. Yeah. That's the central pillar of your report.
Absolutely, Menaka. So what does borrowing do in effect? I mean, if you look at it in very simple layman terms, borrowing is essentially bringing forward your future.
Yeah.
Right? You take your current income, multiply it by a factor, and you spend it. So you've spent your future income. Now you're going to spend the rest of the 10 years paying down that debt. So that's how the American economy, or even in fact the Western overall economy, and more recently Chinese economy, registered those growth rates. For the US it was between 1980 and 2000. For China it was the last 10-15 years. There's a substantial increase in debt. Now for India there were two impediments. First was cultural, which is that a lot of Indians don't like to take debt at the individual level. And the second was the banking system and the way it did its lending. So the first thing I think is now being overcome. So that's not actually to do with digital India. It is just a shift in culture, which is, I keep saying this so often, but my father never borrowed money. I've never borrowed money. Presumably you've not borrowed money, but the 20 and 30 somethings here in the Bloomberg studio are all sitting on borrowed money or looking to borrow money. They're looking to spend their future income and enjoy its fruits today. So that culture shift is happening. You can see that in personal loan growth. That's running in mid-teens. It's not coming out of any availability of data, but actually a culture shift. The banks are capitalizing on it. The second bit is on how banks did lending. So hitherto, banks did lending by providing a loan against collateral. So you put a collateral on the table, they value the asset, and then they give you a loan. It was not cash flow based. The Western world moved to cash flow based lending a while back. In India we couldn't, primarily because there wasn't enough data available. Also because a lot of micro enterprises in India didn't pay taxes, so you couldn't rely on their claims on their finances. That will all change with GST. And the thing that's often forgotten about GST, and especially in the current situation where there are a few issues around GST, is that it's a fully online platform. All the filings that you make can be forwarded, which
if you can make any, given the current circumstances.
See, I think you have to understand that we got 9 million enterprises that have got registered on it. There were bound to be teething problems. In fact, I revisited what we had written about this in May and June. And we were expecting it to be quite worse than what it is today. So in fact, it's been smoother than what the general expectation was. India has, in the stock market, has underperformed since April, emerging markets, even though we may be up in absolute terms. Yeah. China is up 41% year to date, India is up 20%. Why is it underperformed? It is underperformed largely because the market was expecting GST to produce near-term growth pangs. So the actual rollout has been smoother than expectations. We think it may actually persist for a few months before things smoothen out. So when that data becomes available, and it will take a few quarters for that data, it's not going to happen tomorrow morning. Sure. That will provide, for the first time in India's history, banks the ability to lend on cash flow. And when you take collateral out of the equation, you can actually take that credit down the revenue and profit curve of enterprises. So the top 20 or 25,000 firms in India took bulk of the bank credit. It was not a truly capitalist society. Now you can take that down to the 9 millionth firm in the country. Imagine what revolution that will create. That is what this report is all about.
Okay, I know Niraj and Ira have several questions, but I have one last macro question to ask you on this, and that is how much of this, you studied this India vis-a-vis US, vis-a-vis China, you also studied it vis-a-vis Japan when it came to the savings rate. How much of this expansion in the financial services sector, financial credit sector, is going to be supported by savings in any way? And therefore, what does it say about the structure of the economy 10 years from now? We've seen the US pay a fairly heavy price for what you've just described as consumerism, or capitalism, however you want to call it. So have you studied that at all and taken a look at whether the structure of our economy will be at all different?
Yeah, that's as good a question can get. Okay, I think that's the best question I've been asked since we published this report. And very few people are looking at the other side of the balance sheet. because a lot of this is about the liability side, but the revolution is happening on the asset side in India. It's already underway, with or without digitization, because there's a big shift happening there. It's coming out of cumulative change in regulations. The fact that, you know, if you go back to the 90s, and this will take a slightly longer response from me, Indian stock market was faced with back-to-back scandals. You go all the way back to 1992, and then we had one every year. We had a blow-up every couple of years. It took a while for SEBI to get itself settled in. It was formed only in 94. It took 5-7 years for them to actually understand the Indian market, to get rid of the archaic systems that were prevalent, and to make the whole thing electronic. It went electronic only in 2002. I remember that very vividly because we had a vault in our old office which we converted into a gym. Because we didn't know what to do with the safety vault because there was no paper to handle. So that's only 15 years ago. It isn't a long time ago that we actually had all these regulations come in. It takes time, but the cumulative effect of this regulation change, as well as a lot of money and time spent on educating investors, is that finally people in India have got the joke, which is if you want to invest or save for the long run, you have to save in a financial asset. Even better, save it in equities. So we're seeing this tumultuous shift on the household balance sheet. Now think about the household balance sheet in India. It's got $1.7 trillion of gold and $350 billion of equities. I don't think there's any place on the planet where households own 4 times more gold than the whole stock. I mean, this country has got such ownership of gold which yields nothing to you. It just sits in it actually costs a lot of money to even store it, and it just sits in your vault, okay, waiting for price to appreciate. Compare that to a financial asset, which is usually a yielding asset, including equities, and which grows with cash flows, underlying cash flows of enterprises. Very different. So that revolution is only happening now. People, look at last month or the month before last, since we're now in October, the domestic mutual fund flow of $4 billion and say, oh my God, this is a bubble. But the point that we're making is just about starting now. Because we're just making that shift today. And that is, I think, the big deal here, is that digitization is going to give a further push to this shift on the household balance sheet. So on the liability side, greater lending, but on the asset side, more financial saving. This is also good news for capital productivity in the country, because we used to save in non-productive assets, i.e. gold. Now we are saving into financial assets, which can be converted into something that can actually yield output, something that will yield jobs, which then fuels income, fuels further saving consumption. It's a virtuous cycle. We're just starting that.
So your estimation is our savings rate will be higher than that of the US, let's say 10 years down? When you
it's already higher. It's already higher. But Menaka, you look at the, so also the investment rate will go up.
Right.
So if I were to just, refine your question, will we run a current account deficit? I think mostly yes. Unlike China, which ran a current account surplus, which saw such a big rise in saving, they couldn't actually keep investment rate at that level. I think the likelihood is that India's investment rate will remain higher than saving rate, which is we'll run a mild current account deficit.
Okay. Niraj, Ira?
Yeah. So, I was just looking at your report, a couple of things. So, you mentioned that we'll probably be a 6 trillion market cap by 2027. Financials and consumers, 2 trillion apiece. That leaves the remaining 2 trillion for a bunch of other heavyweight sectors as of now. What from now until then underperforms to be a part of the remaining leftover 2 trillion club, if I can use that term?
See, in all likelihood, external facing sectors, because the likelihood is that the world will grow slower than India. Therefore, anybody who's relying on global marketplaces to drive their earnings will probably have lower growth. So I think fundamentally speaking, I think software services and pharmaceuticals fit the bill. Materials, energy to some extent, they will be more cyclical and therefore may not create the same wealth that domestic consumption and financials. So we talk about that in our report, which is that this gain of market share, market cap for consumer stocks and financials will come at the expense of export sectors.
Yeah, so which is the math? But my question to you is, I remember a conversation that we had about a year and a half back, wherein you mentioned, you were one of the few people who mentioned that you believe software services will make a comeback. Now, selectively they have, absolute terms they haven't. Do you reckon that over the course of the next 1 year to the next 10 years, they will stay underperformers compared to a bunch of other places.
I don't quite remember when I told you, but if it has been over the past few months, it's been a spectacularly poor call.
No, it was a year and a half.
Software has really underperformed compared to my expectations. It did not bounce back. However, saying, put into context of your earlier question, of course there will be periods when, software and pharmaceuticals both will do well. I mean, we could be entering into such a period now because the sectors have got so badly, hurt. And you always get those trades, but they remain as trades rather than compounders. I think the compounders will be consumers and financials, and you will keep getting trades in all this. I mean, take for example materials. It's been the best performing sector year to date.
True.
So can you get such years again in the next 10 years? Of course you will.
Okay.
Will they be compounders? Unlikely.
The other interesting bit, and maybe Ira has some questions on this as well, but if I look at your list of the top financials, you are clearly shying away from PSU lenders in a big way. If at all, some reasonably mid-sized, small-sized in the overall context, private sector financials are finding their space over a 10-year period.
So let me explain this. It's a very important point. The public sector banks today account for 70% of the system versus 100% say 15 years ago. They've lost 30% market share. We think they will lose market share at the rate of about 3% a year or maybe 4% a year over the next 10 years. So their market share will decline to half of what it is currently. All that is available for the private sector to gain. So it's a no-brainer for the private sector. Why is this happening is because I think fundamentally it looks like the public sector banks will not get enough capital to grow. They will get capital to backstop any problem. So they will not be a failure. But I think we will enter 2019, which is when Basel III requirements are to be met, with most of the public sector banks at 6.5% tier 1, which is the minimum capital required for them to survive. I think just a handful of them may have more than that, which is required to grow. And I think there's a philosophical shift that has happened, which is no longer are we pumping taxpayers' money into public sector banks to grow them. They've not proven to be an efficient way of dispersing capital in this country, and I think that's probably the call this government has made, consciously or unconsciously. And therefore the public sector banks as a group, I think, will end up losing share. Can there be one or two exceptions? Of course, that could happen, but I think as a group, they will probably end up losing share. It is very akin, and this is again a very cliched one, but very similar to what happened to the telecom sector in the late 90s, right? We privatized the sector instead of privatizing the public sector companies in that sector. I think we're seeing the similar thing, which has been going on for a decade now, but probably continues for the next decade, which is we privatize the banking sector rather than the public sector banks. Ideally, we should have privatized the banks, but then there are constraints around that, so that's not happening.
A couple of concerns or just questions. So, this whole story about lending on cash flow basis, analytics, etc. So the NBFCs are buying into in a big way. Some of the private banks are as well. But I think there's sort of a niggling fear at the back of all the conservatives' mind that this is not being tested over a business cycle. You don't know how these people are going to behave in a down cycle. These models have not been tested in India in a down cycle. Would you hold on to that as a bit of a fear, or I mean, it has to be, right? I said the conservatives think that way.
Let's at least get an up cycle first.
But I mean,
of course there will be problems in the down cycle. That's how these things happen.
You don't want NBFCs get, with the kind of growth rates that NBFCs and MFIs have been talking about, it's a little scary, right? I mean, 40%, 50%, not on a low base.
So I suppose the accompanying question to that is, do you feel regulatorily they are, strongly looked at least as strongly as banks?
I think they are. All my conversations with the RBI suggest that they're keeping a very keen eye on what's happening. And I think we should not be worried about that. But will there be a down cycle? Of course there will be one, but the first the up cycle has to come, which is what I think will happen in the first 5 years of the next 10 years, and then the down cycle will come. Which is why one of the things that I've said about the market forecast is that the 100,000 is not coming in 10 years, it's coming in 5 years.
So you're expecting it to be front-loaded?
Yeah, it will be front-loaded, non-linear. And then I think you get a down cycle.
Non-linear is important to say, right? Because almost always viewers expect, but you said 100,000, so why is it not moving in one straight line to 100,000?
Stocks don't move in a straight line.
No, I know.
They're not
fixed
income securities. They're not fixed income securities. They tend to be bunched up in terms of returns. We've done this work a couple of years ago, and maybe I should write up this in BloombergQuint's next article.
Yeah, actually you're overdue on that, if I may remind you.
So the thing was that if you remove the 100 best days of the stock market, then your returns from the stock market collapse. Likewise, if you remove the 100 worst days, The 17% number goes to 25, 26%. Now, but the challenge is, how do you know which those 100 days are?
I think you've written something similar for us already.
Yes,
so
I may have,
go to BloombergQuint.com and read it up. He's an infrequent writer, I may warn you at that. Just for viewers who may not be fully familiar with the list of stocks that you all have recommended as winners on the basis of this hypothesis that you put down in the report: Bajaj Finance, Edelweiss, HDFC Bank, ICICI Pru Life Insurance, Kotak Mahindra Bank, LIC Housing Finance, Mahindra and Mahindra Financial Services in the financial sector. And in the consumption sector, there's Asian Paints, Aisha Motors, ITC, Make My Trip, Maruti Suzuki and Ultratech Cement. And since we're talking stocks, one question on most of these financial companies that you've referred to could get upended by big technology changes in the financial space. So fintech. In your report, you've already referred to how some fintech companies are offering very innovative forms of supply chain financing, which is what many of these companies are not already doing. When you do a 10-year forecast, you run the risk of many of these companies either becoming redundant or being outpaced by new companies, right, coming in?
Yeah, true, Menaka, but of course we are in touch with these companies and we are happy to see how they are evolving to the fintech world. And a lot of these banks are actually doing a great job. In fact, more than this, just this list. We find a bunch of banks actually responding to the fintech challenge. In fact, some of them have been way ahead of the curve. And I've been interacting with some of their CEOs and they've been talking about this for 4 or 5 years, well before the word fintech actually became fashionable.
So you're confident that they will manage the competitive scenario?
See, confident is always a dangerous thing to be.
You put a 10-year report out there, so you got to back it.
So it's all caveated, with all the risks that are there. So there will be idiosyncratic risk. Not everybody is going to be able to deliver. Some will, some may not. But I think as far as some private sector banks are concerned, and they are not some, i.e. not 3 or 4, but a handful of them, like 20, 25 of them, I think are very alert to the fintech world and are preparing themselves for the fintech world. In fact, a lot of it is also in the public domain. You can see it in the news flow. You can see it in their products. You can see it in their websites, in their apps. So they are very alert to the fintech world. That's the front end. And at the back end also, which is actually these banks are already using data to be able to lend. So they are, I think, a step ahead of change.
I have one more question. You have ITC in your consumption list. In fact, we discussed this when you were presenting this report to a select group of journalists. And you've made the point in this report that as consumption levels move up, people move away from food categories, right? They move to other kind of discretionary spending. Of all the companies that you've listed here, that are pure consumer space, the Asian Paints would also, sort of fit that bill and maybe would Make My Trip in Maruti as well. Why have you picked ITC? I mean, its consumer business is all food based, and to be honest, it's more a tobacco business now than anything else. And its fortunes rely mostly on that, right? I mean, let's be honest, it took a long time to get any of its other businesses up and running or profitable. So
I don't want to be drawn into single stock comments here, but let me just explain the consumption theme for a moment. So today, 60% of India's consumption is food, because we are a poor country, a poor nation. 400 million Indians presumably don't get a second meal to eat. So we're really very poor. So we spend bulk of our money on food. Now, as the incomes grow, and in this report we have cited that the likelihood is that our per capita income goes from $1,700 to $4,100. That puts us into high middle income category. When you become high middle income category, your food basket stops growing because there's only that much food that every individual can eat. So the possibility here is that the share of food drops. Now just think about it mathematically. If 100 rupees is what you spend on consumption today, 60 rupees is food, 40 rupees is non-food. If food stops growing, then when 100 goes to 110, 40 has grown by 25%.
Forgive me for interrupting you. That's a well understood precept. Yeah. I'm just asking you on why pick ITC in this space.
So I'll refrain.
I mean, there are so many other consumer companies.
I'll refrain from single stock comments, but all stock calls have to have 2 things in it. One is the fundamental story, and the second and the most important thing is the price you're paying for that business.
Okay, so that explains why you.
So you got to have a valuation framework. You cannot buy, if you buy stocks that are trading at very rich valuations, the likelihood is that, yes, of course, fundamentally they may continue to do well, but you may not make money on the stocks. Because at the end of the day, I cannot get tired of reminding people we don't buy companies, we buy stocks.
You think Indian auto stocks will survive the EV onslaught?
That's a very interesting thing. It's beyond the scope of our report. I think a lot of Indian companies are preparing for EV, and EV will be, I think, a completely separate debate. But it is a very interesting situation, and it goes beyond autos. Think about the entire ecosystem that is affected by EVs. Autos is a very small part of it. You have auto parts, you have refiners, you have the distribution companies, you have the electricity companies, you have the real estate companies. It's a very long list of sectors that get affected by a simple move of taking India's automobile industry to EV.
Can I tie in that question? Yes. OMCs have been the heroes of the last 3 years. Is that industry under a cloud because of electric vehicles? I mean, I'm taking a 5-year call right now.
Not yet, I think, Niraj. Okay. I think 5 years is too small a time frame for EV to evolve.
In India, okay.
If you look at the US, and we've just put out an EV report, global EV report, the US is talking 20% by 2030. Incremental sales from EV, not stock.
Okay.
Okay, so I think we're talking about not 5 years, we're talking about a much longer time frame, a few decades before we actually move completely into EV. The OMC story has been more about removing government intervention and therefore releasing their real return on capital.
Sure.
So they were depressed, they were subsidizing the Indian public. Now they have ceased to do that, so the returns have gone onto their balance sheet. So I think that's been the story, very well understood now.
Yeah.
You're not a big believer in the India infrastructure story. None of your stock picks seem to suggest that you would expect infrastructure story to come back.
No, infrastructure is, I think, going to be very crucial in the next 5 years. In fact, I would opine that it will lead India's capex. And already infrastructure spending has exceeded the previous high, quietly. Okay, we're 9.5% of GDP. The previous high was 9.4. We've exceeded the previous high. This year, I think we will even go into double-digit spending. China did double-digit infrastructure spending for 10 years on the trot. We'll do it for the first time in our history next year. I think that we'll probably get 5 years of double-digit infrastructure spending. So that's certainly a story, but it's again not part of the digitization story, so it's not covered in this report. Yeah.
Okay.
The other struggle is identifying stocks that will win. Yeah. So it's a motley group of companies that operate in the infrastructure sector. I need some brand new stuff out there to get listed.
Mika, just before we do that, if you don't mind, we're just perilously close to 10, and Rhythm has an insurance play out here. We have an insurance company listing. Just need to mark that. Maybe throw in a question on insurance before we do something else. But SBI Life just about to get listed. That's Arundhati Bhattacharya bringing in the gong. Remember the issue price of 700. Let's wait and watch. Expectations were that there could be a bit of a discount on this listing as well. 736. Yeah, okay.
That's a bad.
Okay, but that's not a bad listing compared to what the market was estimating.
Compared to the other two as well, right?
That too.
ICICI Pru and ICICI Lombard.
Yeah, so 4.5% on SBI Life. That's about 733. 730. Okay, not a bad start. We'll of course get in the management a bit later on as well. But Rhythm, just a quick question out here before we get in viewer queries. Insurance, and there's a mention there, but it's an evolving sector, a large one at that, but evolving. Do you think it's miles to go? And
it's the same story that I mentioned to Menaka earlier on, which is the restructuring that's happening on the household balance sheet on the asset side. So insurance will get more popular. Penetration will rise quite meaningfully in the next 10-15 years. So a lot of companies will do well.
But people are buying stocks, right? Not companies. These stocks are not cheap. Right now, at least.
Yeah, so I think the market overall actually is pricing in some growth recovery. So I think you have to look beyond the next year or two now. Stocks are not like they were in 2003 or they were in 2009. So the way I look at this is not PE but price to book. Because earnings can go up and down a lot, by the way. Okay, so PE ratios do not convey the underlying value. If you want a simple ratio, then price to book. Price to book in 2003 was about 1.7. In 2009, it hit a trough of 2. Today we are at 3 for the market on the aggregate.
We have those graphics coming up for the market as a whole, for the Sensex as a whole.
Yeah, so stocks are not that cheap that I can keep everything aside and just buy them. That's not the moment, but they're not expensive either, because at the peak in 2008 and at the peak in 1999, at the peak in 92, stocks were at 5.5 times book. So we're somewhere in the middle of, in fact, we're closer to the low point, but we're right at the middle, average of India's history. So valuations on their own do not actually give me any clue of where stocks are heading. I need to overlay that with fundamentals and with my growth outlook. So there is a issue of risk reward here. It's not like you close your eyes and buy stocks. I think you have to make your selections. And yeah, you may be right that not everything in the market is actually attractively priced right now. Some of it is looking forward a little too much in terms of growth and maybe discounting the next 3 or 4 years.
Which ones of it you're referring to?
No, I think some in the consumer staples space, for example, I think are looking far too forward in terms of growth, and I think you may go through a period of zero returns relative to the market in some of these stocks. A few NBFCs also have gone into that territory.
No.
But the market as a whole, I think, is okay. It's not
One last question coming in from a viewer. In the interest of time, we'll keep this short, but it helps us bring you back to not from 2027 to 2017. The question comes in from Devendra Singh saying, what happens when liquidity dries up? How sharp a correction will we see from this level? I hope you'll put a number to that rhythm, most uncharacteristically. But more important question, your view on the economy right now, because I know earlier you said that you believe that it had troughed out.
Yeah. So let's take the second question first. So I think, the economy has troughed out. We had actually, I think it would have troughed out last year only. But the demonetization incident and then GST both, I think, rolled us back by a couple of quarters. So I think the trough was put in last September. And then we got a little bit of an aberration. So what we saw in the June quarter was probably the bottom. And from here on, I think you should see the economy recover. On the question on liquidity, again, my last...
You've only seen the beginning.
No. My last edit was on what is liquidity. And most people conflate liquidity with flows.
Yeah.
Liquidity is not flow. Liquidity is the bid. It's the strength of the bid or the strength of the offer, as the case may be, if it's positive or negative. And the strength of the bid is a function of psychology. It's a function of expectations. It's very hard to forecast. I can only describe it, I can measure it, I can't forecast it. At least I don't know how to forecast it. So we have provided, and people can go to Bloomberg.Quint, I've provided 4 different ways of measuring it.
Yes.
When those measurements tend to reach a very high level, like think about a thermometer, which measures body temperature, and until a few tens of years ago, we didn't understand body temperature, we could only measure it. But when it approaches 105, 106, you know it's a problem. You know you are approaching dangerous territory and you may die. So same thing with these measurements is that if they approach those type of levels, which historically have corresponded with markets peaking out, you know it's danger. We're nowhere close to that. So for the time being, I don't think the strength of the bid is going to go away. With respect to flows, I think we're here for a secular shift. I believe from my conversations with fund managers domestically, September was even better than August. And just think about it for a moment, September was a really bad month for the markets in terms of volatility and the way mid-caps got crushed. And if the retail investors got even more bullish, it tells you something about their fresh psychology now compared to the past. So I think the bid is still strong. What will upset it in my view is global, not local, which is that if globally things turn nasty for some reason, and that's not our base case expectation, we think actually we're in a pretty sweet spot globally, then I think it will affect the bid here as well.
All right, Rhythm, we're going to wrap it up there, but thank you so much for spending some time with us, taking us through your report personally, and answering the many questions. If you have any more questions about the report, you can go to BloombergQuint.com, and to read all the op-eds that Rhythm referred to, go to BloombergQuint.com. With that, we'll wrap it up and hand it over to the FNO show, which has been waiting impatiently for us to finish this conversation.
Yeah,
right?
so take more conversations on the SBI Live listing as well on the other side of this break. Thanks so much for tuning in to Indian Open.